I get it. Technical analysis can sound super intimidating, but really, it's just a fascinating way of trying to find the story hidden inside market data. So let's just dive right in and break it down. Okay, so have you ever pulled up a stock chart and just felt completely lost? Like you're staring at a bunch of random, meaningless zigzags? Yeah, you are not alone. At all. But what if I told you those lines might actually be trying to tell you something?
Well, believe it or not, they just might be. Those ups and downs aren't always just random noise. They're telling a story about what investors are thinking and feeling. And technical analysis, that's the language investors use to try and read that story.
Okay, so what is technical analysis really? Well, at its core, it's all about looking at the past, things like a stock's price history and how much of it was traded, to try and forecast what might happen next.
See, the whole point is to try and get a sense of where a stock might be going. Is it heading up? Is it heading down? And based on that, you can maybe spot some good moments to get in or, get out. It's all about finding signals in the chart's history.
All right, so where do we even begin with all this? Well, the absolute bedrock, the foundation of it all, is identifying the trend. This is always step one.
And honestly, it's way simpler than it sounds. An uptrend? That's just when you see the price making higher peaks and the valleys in between are also getting higher. And a downtrend is, you guessed it, the exact opposite. Lower peaks and lower valleys. That's it. That's the trend.
Okay, so once we know which way the river is flowing, so to speak, the next thing we look for are the river banks. These are like invisible floors and ceilings that the price just seems to bounce off of. In the world of technical analysis, we call these support and resistance.
Let's talk about support first. This is that price floor. It's a level where buyers seem to get really interested and start stepping in, which stops the price from falling any lower. You'll see the price hit this level and just bounce.
And resistance? That's the ceiling. It's the price point where sellers start to think, maybe it's time to cash out. This creates a barrier that the stock has a tough time breaking through.
Now, this is where it gets really, really interesting, because these floors and ceilings, they aren't made of concrete. So the million-dollar question for any analyst is, what happens when the price does break through?
Well, think about it. If a stock smashes through that resistance ceiling, that's a pretty strong sign, right? A lot of traders see that as a green light, a potential signal to get in because the stock might just keep climbing. And on the flip side, if it crashes through that support floor, that can be a red flag. It might be a signal that it's time to get out because things could keep dropping.
Okay, let's keep building on this. When you start drawing lines to connect these floors and ceilings on a chart, something pretty cool happens. You start to see shapes forming. And these shapes, believe it or not, have names. We call them price patterns.
And while there are a ton of them, some are pretty simple, like triangles and flags. And then you get the more, let's say, creative ones, like the famous head and shoulders or a triple top.
Let's just take one to show you what I mean. The ascending triangle. This pattern shows up when you have a flat ceiling, that resistance level we talked about, but the support floor is sloping upwards. The price gets squeezed tighter and tighter between these two lines. A lot of analysts see this as a pressure cooker, a sign that the price is getting ready to pop, usually upwards.
But here's the thing. Drawing lines and finding shapes, it can be a little subjective, right? What I see as a perfect triangle, you might see as just a bunch of wiggles. And this is where we bring in the math. We add another tool to our toolbox, technical indicators.
Yeah, this is exactly the problem that indicators are designed to fix. They help remove some of that guesswork. They're basically just formulas that take the chart's data, price, volume, you name it, and turn it into a more objective signal.
So instead of you trying to eyeball a pattern, an indicator does the heavy lifting for you. It plots a new line right on your chart based on cold, hard math to help confirm what you're seeing or maybe even warn you about something you missed.
A super common, classic example is the moving average. It just smooths out all the short-term noise by showing you the average price over a certain time. And a really popular one that you'll hear about all the time is the 50-day moving average.
And reading it is pretty straightforward. If the current price moves above that average line, it's a sign of strength. It's performing better than its recent past, which could be a potential buy signal. And if the price dips below the average, that suggests weakness. And for some, that's a potential sell signal.
Okay, so we've covered a lot, right? We've talked about trends, floors and ceilings, patterns, and indicators. But before you run off and start drawing lines on charts, there is one absolutely crucial thing you have to remember about all of this.
And it's this.
Technical analysis is not a crystal ball. These are tools to help you analyze possibilities and manage risk. They are not, I repeat, not guarantees of success. Nothing can predict the future with 100% certainty.
And that kind of brings us to a bigger, more philosophical question, doesn't it? Is successful investing more of an art or is it a science? Technical analysis gives you the scientific tools, the data, the formulas. But knowing how to combine them, when to trust them, and when to be skeptical, well, maybe that's where the art comes in. Something to think about.